Does a homestead exemption lower your mortgage payment? Short answer, sometimes. Here's what they don't tell you. An exemption doesn't touch your interest rate or your loan balance. It lowers property taxes, and that can shrink the tax piece of your monthly bill. Let's make this super clear in the first minute. Your mortgage payment is usually a bundle: principal and interest, what pays down the loan, plus escrow for property taxes and homeowners insurance. Some people also have mortgage insurance. A homestead exemption is a tax break for your primary home. It either knocks down the taxable value of your house or gives you a credit on your tax bill. So if your lender escrows your taxes and your taxes go down, the escrow part of your monthly payment can go down too, once your servicer recalculates it. If you pay property taxes yourself, your mortgage check to the lender won't change, but your tax bill will be smaller, which still saves you real money. Now, what is a homestead exemption in plain English? It's a homeowner-only discount that most states and many cities or counties offer for your main residence. Some places give a flat reduction in assessed value. Some give a percentage. Some add extra breaks for seniors, disabled homeowners, or veterans. In a few states, you also get a cap on how fast the taxable value can rise each year on your homestead, which protects you from giant jumps. You usually apply once, prove you live there, and it renews automatically. If you move, you file again at the new address, and the old one loses the exemption. Here's where it touches your monthly payment. Lenders run an escrow analysis, usually once a year. They look at what your taxes and insurance cost last year, and what they're expected to cost next year. Then, they set your new monthly escrow amount to hit that total. If your homestead exemption kicks in, and your tax bill is lower, your next analysis should reduce the escrow portion. You might also get an escrow refund if you've been overpaying. Some servicers will run a mid-year analysis if you ask and show proof of the new lower tax bill. Others wait until the normal cycle. Either way, the savings shows up in the escrow line, not the loan line. Let's run a fast example so the math feels real. Say your home's assessed value is $300,000 and your local tax rate is about 1.2%. That's $3,600 a year in property tax. Your escrow sets aside $300 a month for taxes. You file a homestead exemption that knocks $50,000 off the taxable value. Now, you're taxed on $250,000. At the same rate, that's $3,000 a year, $600 less. When your servicer recalculates, your escrow for taxes can drop by about $50 a month. You didn't change your interest rate. You didn't refinance. You just trimmed the tax slice of the pie. A few important "it depends" points, said simply. If you don't escrow, your lender payment won't budge, but you'll owe less when the tax bill arrives. Same savings, different timing. If your insurance premium goes up while taxes go down, those changes can cancel each other out in escrow, so your payment might stay flat even though the exemption helped. If you just bought the house, the prior owner's exemption may not carry over. Many places remove it at sale, and you have to apply in your name, so your first year tax bill can be weird. And if your area revalues properties higher at the same time, you claim the exemption. You might still see a net tax increase. Smaller than it would have been, but not a drop. The exemption is a shield, not a magic wand. Common confusion. Number 1, homestead also shows up in laws that protect a portion of your home's equity from certain creditors. That is a different homestead concept. Helpful, but not what changes your monthly bill. We're talking about the property tax exemption that local governments administer. Common confusion number 2. Will a homestead exemption lower my mortgage balance? No. It never changes the principal you owe or the interest rate you locked. It only affects the tax line, which can lower your monthly out-of-pocket if taxes are part of that payment. So, what's the catch? Mostly timing and paperwork. Many places make you apply by a deadline early in the year for it to count for that year's taxes. Miss it, and the discount waits until next year. You'll usually need proof this is your primary residence. A driver's license with the same address, a voter card, something like that. Once approved, watch for the change on your tax account online or on the bill. As soon as you see the lower amount, you can call your mortgage servicer and ask for an off-cycle escrow review, or just wait for the regular annual analysis. Let's walk through a simple plan you can copy this week. Step 1. Check your mortgage statement to see if you escrow taxes. It will show an escrow line if you do. Step 2. Look up your county or city tax assessor and search your address to see whether a homestead exemption is already on file. If it isn't, grab the application from their website and file it. Free. Step 3. Put a reminder on your calendar for when tax bills post in your area. When the new, lower bill shows up, send a copy to your mortgage servicer and ask whether they'll run an escrow analysis now or at your next cycle. Step 4. When the analysis lands, read the letter. If there's a surplus, you might get a check. If the monthly escrow drops, you'll see a smaller total mortgage payment starting the following month. Let me give you 2 quick stories so you can feel this in real life. Jamie buys a house in April. The previous owner had a homestead exemption, but it fell off at closing. Jamie applies for their own homestead right away. In October, the county posts the tax bill reflecting the new exemption. Jamie emails it to the servicer, who runs an early escrow analysis and lowers the monthly payment by $42, starting in December. That's groceries money every month with a free form and 1 email. Sam owns a condo with no escrow. Taxes are paid directly. Sam's homestead exemption cuts the annual bill by $380. The mortgage to the lender stays the same, but Sam budgets $32 less per month for taxes and uses that to bump principal payments by $30. That small extra payment knocks a few months off the loan over time. Same savings, now working double duty. A few do this, not that tips to keep you out of potholes. Don't pay anyone who mails you an exemption service offer. Filing is free and fast. Don't assume the exemption follows you automatically when you move. File a new one at the new address. Don't claim an exemption on a second home or a rental. That can bring penalties. Do look for add-ons you might qualify for. Some places have extra reductions for seniors, disabled veterans, surviving spouses, or people with certain income levels. Do keep a copy of your approval in your files and check your online tax account each year to make sure the exemption still shows. Here's the key moment answer you came for in one line. A homestead exemption can lower your mortgage payment if your lender escrows taxes and recalculates the escrow after your tax bill drops. Otherwise, it still lowers what you pay in property taxes, just not the principal and interest part of your mortgage. Let's bring it home. A homestead exemption is a simple tax break for your primary home. It doesn't rewrite your loan, but it can trim the tax slice of what you pay each month. File once, watch the bill, nudge your servicer for a review, and let the savings roll into a lower payment or into extra principal if you don't escrow. Small move, real money, zero drama.